2 low-cost index funds that will match the market. Guys, I hear different numbers all the time, but the bottom line is actively managed mutual funds suck at beating the market. I've read as low as 2% over a 10-year period, and the highest side I've ever read is 8% over a 10-year period beat the market, and you're paying insane fees. So there's a reason why all the smart billionaire investors tell you to buy low-cost ETFs. SPY, VOO. There's a ton of other ones out there. The bottom line is they have super low expense ratios. How low? Well, SPY is 0.09%. VOO is 0.03%. The typical mutual fund is 0.75 to 1.5%. Wow. And they don't beat the market. So this matches the market. These don't even beat, and you pay these huge fees. Mo, were you like me? Did you only invest in ETFs for a long time?
For the most part, yeah.
I did.
For the most part, I just threw, I mean, even with my retirement stuff, I just throw it in there now.
And I loved it because I was like, you know what? I'm going to go focus. When I first started my business in real estate, I'm like, I'm going to go focus on real estate. And I bought a lot of ETFs. I bought individual sectors. I bought SPY, a ton of it. But then as time went on, my time freed up and I was able to learn more about individual stocks. My ratio went from 100% of ETFs down to 0, but it took time. I went from 190 to 80 to 70 to 50, etc. And that's what I recommend doing. Listen, picking individual stocks is a ton of fun and you'll get there. Trust me, we will guide you along the way. That's why you need to watch it. We will guide you, hold your hand to learn how to buy individual companies. But like I did, I started by buying ETFs and understanding the emotional part of investing.
Yeah, because you can see when stocks fluctuate up and down, you're gonna catch both those sides, but over a long time, you're gonna be on this time horizon.
So what Mo's talking about here is I've drawn this graph 1,000 times, maybe 2,000. That's what the market does in value over time. But this is what the price does. And that's why I want you to buy low-cost ETFs, because you know what most people do? They buy here and sell here. It's absolutely the wrong time. So instead, low-cost ETF, dollar cost average, buy along the way. Sometimes you overpay, sometimes you underpay, but over time you pay this amount. Yep. And you match the market. That's the big thing. You know what mutual funds do? I'll just show you a little graph of mutual funds. Yeah. This is probably what I perceive mutual funds to do in most part. Here's the market, and here's what they do.
Yep.
But over a 40, 50-year period, making 6% a year still feels like you made a ton of money, and people don't realize it.
Right. It's your account's going to go from 100,000 to maybe 1 million, and you're like, oh boy, that's great. Well, it probably could have been 3.5 million.
That's the point, and that's why we have retirement calculator in our software. This is a very, very useful tool. The reason being is most retirement calculators out there will sit there and say to you, "Hey, you have X amount of dollars at retirement. You're good." No, I want you to look at how much money you have to your estimated time of death. As morbid as that sounds, the last thing I want you to do is be 85 years old having to get a part-time job because you didn't realize that because of costs increasing, saying you have 2 million 40 years from now sounds like a lot of money, but it really ain't. So I'd rather have you be cautious and know, hey, let's go the truth right now. And that's what our retirement calculator does. Now, more importantly, I also want you to look at the difference between mutual funds that are actively managed by all these Harvard MBAs and all these guys saying, oh, we're so smart.
We're smarter than the market.
Oh my God, they're so dumb.
You're not smarter than the market.
No, you're not.
There are very few people that are smarter than the market.
By the way, they might be smarter than the market, but you know what they also are? They also have career risk. They can't afford to be wrong. Their job is to stay as close to the market as possible.
So when I was in med school, I had somebody that was managing some of my money for me just because I couldn't do it. And I was not in ETFs at the time. So I was like, okay, you guys do this. They called me one day. They were like, I think we're going to start getting into Amazon right now. It's looking pretty cheap. And I was like, excuse me. And this is what they have to do though, because I wasn't in Amazon, they probably perceive it as this guy's gonna be pissed if he's not in Amazon.
Correct. Now, by the way, I guarantee Mo would have made money on that Amazon bet at that time.
I would have made money on it. Absolutely.
But the process would have been wrong.
Right.
And that's why we're on this show. We're trying to create a process. We are trying to teach a process. And more importantly, the emotional aspect of investing. The emotion and mindset is what's going to help you beat the market. I remember when I first started to realize that being the market was not difficult. It's simple, not easy. Because the hard part about being the market has nothing to do with the numbers or the data. It has to do with the emotional part. Are you okay with seeing a stock go like this and you do the analysis and say, I think it's still a good buy, and you buy it all the way down? No, it's very, very difficult to do that. I'm fortunate that it took me a long time, as it does most people, to sit there and understand that concept. But the benefit you have is you have YouTube and you have ways of learning. But do me a favor. Just because someone has a YouTube channel doesn't make them correct.
I think we're seeing that a lot lately.
We've been seeing that a lot lately. All those YouTubers out there who are endorsing crypto, FTX, and all these things, it just go, and all their stocks that are down 90, 95%. Do I have my stocks that are down? Absolutely. But when my stocks are down, I reevaluate and I buy more as long as my thesis is still the same. They bought stocks saying, oh, stocks are going up, I need to buy it. Well, when it stops going up, what's your reason for buying it? It goes away. So let's go run through this really quickly to show you the retirement calculator. So first off, let's start with an age. Our average viewer is about 32 to 35 years old. So let's call it 35. Retirement age, let's say.
And while you do this, I'm going to do it for a 22-year-old kid that's just graduating.
Good idea.
Okay.
So I'm going to do 65 for retirement. Current savings, you've been saving along, let's say it's at $100,000, and I don't know what it is. And you're saving $10,000 a year. If you increase your saving as you make more money, how much are you going to increase your savings by? Well, if you make 4% more per year, you should increase it by at least 4%. Annualized returns. Now, if you buy your low-cost ETF, the long-term market average is about 10% a year. Let's just call it 9.5. And during retirement, how much do you make? Well, in retirement, you should have less money in stocks, pull it back a little bit. So let's call it 6%. And what age do you expect to live to? I'm going to call it 100 because, guys, as time goes on, it's very likely that you will live a much, much longer life. And you might as well be more cautious now. It's part of the margin of safety. Be more cautious now. Assume a longer life. I mean, look at this, 35 years from retirement until death. You got to have your money last that long. Inflation, let's call it 3.5%. And your current annual income is $100,000 a year, let's call it. And again, it's going to vary for you. Some of you might be like, I don't make $100,000 a year. Fine. You also need less money in retirement if you don't make that kind of money. And if you make more than $100,000 a year, you need a lot more in retirement. The point is just to look at it relatively. And final question. What is your income? What percentage of your income do you want to have in retirement? Do you want to live off the same income level, half, more, etc.? I always put in 100% because you'll probably have a paid off house, but you'll have increased costs of healthcare. You'll probably have a paid off car. You'll travel more. It all weighs itself out. Okay. I hit the generate button. Do you have enough for retirement? Nope. You need $10,000 more per year. So based on this, you need to save $10,000 more per year, $20,000 a year. Okay. But here's the catch. Here's why a low cost ETF is better. At retirement, you have $4 million. See, and that's the thing. If you heard that, you'd be like, damn, $4 million, I'm going to be loaded. I'm not going to need anything. But guess what? As time goes on, your costs go up. You're broke by the time you're 84 years old. Broke. So.
Roll it back down again. Let me see that. That's amazing.
Isn't that incredible?
Yeah.
Because you're just spending more and more because your returns aren't making up for it. Right? So now the scary part. Let's say you invested in mutual funds that not only didn't beat the market, but also charged you high fees. And instead of 9.5%, let's say it's 8% return. Instead of $10,000 per year you need to save, ready for this one? You now need to save $20,000 extra per year. That genius money manager is costing you that much money. Instead of $4 million at retirement, you now have 2.96. And instead of broke at 84, you're broke at 78. How crazy is that, guys? Now, Mo, go to a 22-year-old here.
So here's 22-year-old. I did 9.5% annualized returns, just like you did. Retirement age 65, $3,000 in savings, call it.
Right now.
Right now. Annual savings, I put $7,500, $45,000 a year. Income before tax, 4% savings, 3% inflation. Look at this. At 65,
you have enough.
You have enough. You do have enough, and you are retiring with $6.791 million.
So 6.8, and what do you have at death?
And when you die,
you have 16.6
million.
So you keep growing as time goes on.
Well, let's go to that 8% number. 8% annualized return from the mutual fund.
Instead of 6.8?
You now don't have enough money. I mean, you only need $91 per year more.
Okay.
But 65 years old,
you have 4.57 instead of 6.79.
Exactly.
That's $2.2 million less money.
Just from doing one little thing, giving your money to somebody else.
And by the way,
and when you die, you're broke.
And then when you give money to somebody else, you have to go meet with them. With a low-cost ETF, you just put it away. You just keep putting it in there and you never look at it ever again. And don't forget, it's also highly tax efficient. You're never going to be selling these things in and out. You're going to have no tax along the way.
And here you don't have, what was it, $16 million to give your kids?
Now your kids owe $400,000 to your estate.
Exactly.
So instead of giving them 16.6, you're like, hey kids, congratulations. You owe my estate $400,000.
Exactly right.
So guys, this is the importance of what we're trying to do in this channel. It's one thing to say over and over the right words. It's another thing to question it and realize, is this actually true? Every retirement calculator I've seen stops at retirement. If I told you $4 million at retirement, you've been like, I'm cake. I look on Market Watch all the time, and there'll be people saying, I have $200,000 in retirement, and I pull $2,000 a month. They're like, oh, good for you. And I'm like, how are you going to live?
Yeah.
Unless you live off of $2,000 a month in the Social Security benefits. Mm-hmm. But you can't do anything much else than that.
Right. A common question we get is, SPY is too expensive for me. I save $200 a month. What do I do? Well, this is where this SPLG, this is a great way of coming at it because it's the exact same breakdown. It's actually a little bit more cost effective, but you can go in there and buy it for $46. You're buying the exact same thing. I looked at it. I did a video on this. I did a breakdown on this. It is 100% the same thing. Every allocation is the same. So this is a great option to go in there and buy here. So the big difference is, you can't do really that good of options on it.
Oh, and that's what I was going to get to next,
and I
guys.
want to get to that.
Guys, here's the deal. One of the great things we do on this channel is we like to sell options to generate income. If you join our community for $1 a day with one month, no risk. If you join and 1 month later you don't like it, email us. We'll refund your money 100%. 1 month later, options are generating tons of monies for our users, right?
Yeah, especially in my tier.
Yeah, especially in your tier.
Yeah. And guys, it's the same offer. $79 a month, risk-free, 1 month. Come and try it. What do you have to lose?
We have people in those communities making $4,000 or $5,000 a month just in options. Yep. Granted, they have $1 million portfolio, but if I told you with a $4 million portfolio, you could generate $200,000 a year in income, that'd be incredible. There's your retirement right there.
I really love the kids that are 30 years old that obviously don't have $1 million, but they're still making good returns. They're like, Mom, I'm paying a lot of my bills on this. This is incredible.
And they're investing in their future because the whole point is learn now so that when you do have the money, you're not scrambling to learn.
Exactly. When you have $1 million, and if you're watching this channel, you'll probably have $1 million. You can just hit the ground running. You don't have to learn something and say, oh shit, now what do I do with all this money?
All right. So everythingmoney.com, guys. Again, risk-free, sign up. If in a month from now you don't like it, which I'm very, very confident you'll love it, get your money back, no questions asked. Thank you very much. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?